Good afternoon. I'm Scott Gallagher. I'm one of the Chartered Financial Planners here at Brodie Turton IFA Limited in Leicester. And thank you for joining us this evening for our webinar, What the 2024 Labour Budget Means for You and Your Financial Future. Good afternoon and thank you for joining us this evening. My name is Scott Gallagher and I'm a Chartered Financial Planner at Brodie Turton IFA Limited. This evening's webinar is hot on the heels of today's budget, entitled What the 2024 Labour Budget Means for You and Your Financial Future. So myself and my colleague Martin have been beavering away, looking at the changes that have been announced, reading some of the small print and kind of working out what the changes actually are and what impact they may have on our clients. So just quick agenda, just quick bit of housekeeping, introduction, and then Martin's going to look at what's changed, who's been affected. He and I will give a bit of a conclusion about how we think this impacts people, briefly touch on how Brodie Turton can help people, and then some time for questions and answers. If you have questions during the webinar, could you just type them into the chat box, or question and answer box, and then we will basically go through them at the end. Thank you. Welcome to housekeeping. Microphones are muted and cameras are turned off, so you can see us and hopefully you can hear us, but we can't see you. That's good. So use the question and answers feature to ask any questions, and we'll endeavour to answer them as best we can. After the webinar, a recording of this webinar will be sent to all attendees, so you will get a copy of that along with a copy of the slides. And if you have any technical difficulties, please let us know in the chat. Standard caveats: this seminar's guidance only, should not be taken as independent financial or legal or accounting advice. As such, we accept no liability, etc. Just speak to us before doing anything, I think is the best advice there. Without any further ado, I'll introduce you to my colleague Martin Stanley.
Thank you, Scott, for that introduction. Well, my name is Martin. Welcome to this evening, and the budget has landed. The most eagerly awaited budget for, I think, probably most of my career. It's been widely billed and widely trailed as a really important one, and they always say that, but this time it really is true. I was just thinking as I was stepping up there, I might be making a little bit of a generalisation here, but perhaps this is one of those budgets where it doesn't affect a lot of people a little, but it affects some people a lot. You might be one of those people, and if so, hopefully this will give you some pointers. So what I'm going to do this evening, I'm going to go over some areas of change. You'll see them on the screen there, some broad areas. I'm going to do a whistle-stop tour of what's changed with some implications. Then I'm going to talk about people like you, business owners, buy-to-let landlords perhaps, or just individual people with your wealth and your finances in mind, how that is going to affect you. So without further ado, our first slide is income taxes. Rachel Reeves and last week Keir Starmer made a big deal out of making a big promise that income taxes for working people, however that's defined, would not rise. And the line in the budget today was, it was a promise made and a promise delivered. I think that was the line. And true to their word, there have been no changes to personal income tax. So the rate stayed exactly the same. Now, there's a bit of a cheat because the allowances are still frozen. And what that means is that as your prices go up, and I hope as your wages go up, then you're paying a little bit more and a little bit more tax just because the allowances don't also go up with inflation. Rachel Reeves did announce today that the Tory allowance freeze, which was until 2028-29, isn't being extended. So that's something. So the allowances should start to move again in a few years' time. So nothing changes there really. National insurance, well, following on from no change for working people, yes, no changes to employees' rates. And the line used in the budget was, your payslip next week will look just the same as last week. So there we are. But, and it's a big but, employers' national insurance has increased. When an employer pays an employee, the employee has to pay their tax and national insurance, but also the employer, the company, has to pay national insurance as well. Was 13.8%, now it's 15%. Doesn't sound like a lot, 1.2%, but it's quite significant if you have a high wage bill, and for a lot of companies, the wage bill is the major component of their costs. There's another thing as well, which is the earnings threshold. That's the point at which employers have to start paying their employers' national insurance. That's come down a lot from 9,100 to 5,000. That's another £615 per employee, we think. I say we think because I just want to say again, I think Scott mentioned this, that we have had to look at this pretty quickly. It's been a few hours since Rachel Reeves spoke, and so you'll forgive us, I hope, if some of these things are provisional. We'll find out some of the fine detail tomorrow, I hope. So those are two things that affect employers. So this will affect anybody out there with a business. One nice thing is employment allowance. That's some of that national insurance given back again to the company. That's gone up. So that goes in the other direction. But overall, although employees, workers will not pay anymore, employers will pay a lot more for employing people. This is extra taxes on employment. Just at the bottom there was some speculation that employers might have to pay extra tax on making pension contributions for people, but that thankfully has not come about. So that's something which we can ignore. Right, that's national insurance. The next thing is those things which are of interest to directors and employers, several aspects here. So corporation tax, not changed. So that's a sigh of relief for some people. Dividend tax, whether that's for company directors or just people who hold shares, that's unchanged, so that's great. Employers' national insurance, well, I've just mentioned that's going up quite a bit, and that will be a burden for people who employ staff, especially those people who employ a lot of staff on fairly low wages. So one example that was mentioned earlier in the office was a company like McDonald's that employ a lot of people, part-time perhaps, on low wages. They're going to have that sort of £615 per person addition all the way through their employee bag. So that's going to be difficult. Also difficult for people like that and others is minimum wages increased by a lot, 6.7%. Now, prices have gone up a lot, of course, but 6.7% is still sort of unlooked for by employers at the moment. That's another burden. Right, two other things to do with directors and employers. I'm going to come on to these a little bit in a minute, but capital gains tax has changed, and that will affect any directors and employers and company owners out there who are thinking, in due course, I will be selling my business. So we're going to come to that in a minute. The other thing is business relief, which is to do with inheritance tax. That is business owners who die whilst they still own their business. Normally would expect their personal business not to pay inheritance tax, but that is changing. So any of you who own businesses, you should be listening up to these key things, which I'm going to come on to just in a moment. So here we are then, capital gains tax. Everyone thought, and we were all right, that capital gain tax will be going up. The current rates for individuals paying tax on profits made from shares or other assets that they sell was 10% and 20% for high rate taxpayers. That's gone up to 18 and 24. So quite a big increase. Those of you who are buy-to-let landlords or are familiar with buying and selling properties might recognise those numbers, because they are the same rates that currently apply to residential property, so second homes. So that's now been harmonised with whether it's shares or second homes or any other valuable assets that you might buy and sell and make a profit on. They're now all 18% and 24%, depending on how much your other earnings are. There's a £3,000 allowance. It's only £3,000. It used to be a lot more. It doesn't help you a lot, but still you can make up to £3,000 profit per year, or £6,000 for a couple, without having to think about capital gains tax. So that's a little bit of help. But the key thing is those rates are going up. And I said in particular this was going to affect people who are thinking about selling businesses, because those of you who do have businesses might be thinking, well, there's a special deal for business owners, and there is, and there was, but it's changing. This is what we all still refer to in the office as entrepreneurs relief. It's properly called business asset disposal relief. This is the thing that so when you sell a personal business, the first £1 million is free of capital gains tax, and after that you pay a lower rate. So the £1 million has stayed, but the rate has gone up from 10% to 18%, so matching the new capital gains tax rate for individuals. Now, on that, it comes in over a couple of years, so you don't need to go out and sell your business straight away. It's going to be 10% for a little while, for a year, and then an interim period of 14%, so climbing up, and then it's going up to 18% after that. So you've got 2 years in which to think about selling a business before it goes up to that higher rate. So this is a big deal for those people out there who own businesses who are thinking, well, you know, when I come to retirement, I'm going to be selling it on either to the next generation of family or to, you know, to another business. You will be getting less for your money. But if you're over £1 million, you're getting less for your money, and you might have to be thinking, well, what's my retirement look like? If you are thinking that, that's something which we help people with, that advanced future planning. So, inheritance tax, this was widely trailed as something that was going to be looked at, and it has indeed. But for most people watching this, it probably won't affect you very much, because the main points about inheritance tax that apply to most people haven't changed. And remember, only a small number of estates actually pay inheritance tax. It's fewer than people tend to think. So the bands have been frozen at 325,000 per person. And then you also get another top up of 175,000 residential band. And that's if you leave your home to your children or grandchildren. So that adds up to £500,000 per person, or £1 million per married couple. I say married couple, that's an important point. We're going to come to that in a minute. So the rate is still 40%, which a lot of people think is too high, but that's what it is. Now, the next 2 points are big ones. Unused pensions and death benefits from pensions are now going to be brought under the IHT regime from a couple of years' time. What does this mean? Well, at the moment, stocks and shares and properties and all the things that you own are potentially subject to this inheritance tax at 40% if you go over the limit. But pensions were special. If you had any amount of money in a pension, you could pass that on without any inheritance tax. That's changing. Now, to a certain extent, pensions, the idea of pensions originally back in the midst of time was that these were meant for income in retirement purposes. And that's why the state helped you accrue it. You get tax relief on it, you get money back. And the idea is the state helps you accrue the pension and you use it for income in retirement. And you're not a burden on the state. When that pension is not needed anymore at the end of your life, or the end of yours and your spouse's or your partner's life, then some people will say, well, it makes sense that it then be subject to tax, but not until then. Now, the key thing here is that when you die, yes, your pension can pass to your wife or your husband or your civil partner without any inheritance tax. So that's not changing. And so if you've got a large pension and you've counted on that to provide for you and your family, then it still will do so. When the second person dies, though, then yes, inheritance tax will hit, and the children won't get as much if that's what your plan was. But one big thing here, which has been the cause of much speculation and anger and frustration, is that only accounts for husbands and wives and civil partners. So those of you who have a perfectly great life with houses and children and a life together but happen to be unmarried, will find that when the first person dies, that pension, if it's a large pension and it's subject to inheritance tax, might very well be slashed significantly. So this is very meaningful for people who are not married, partners who are unmarried, or people who are divorced, or people who had planned to leave their pension to someone other than a married partner. So this is something to think about. And the quick answer for some people might be, well, we'll just get married. That is an answer. It's not the answer that we think should be the answer. But that's something that you might want to talk to us about. So I said there were two big things. The next big thing is agricultural property relief and business property relief. Now, that might not mean something to everybody, but what it basically means, this is the allowance, means if you have a personal company, your own company, or your land, really a farm is the idea, then on your death, you shouldn't have to break up your company just to pay inheritance tax. The idea is that otherwise that would break up small companies and companies would never pass down the generations. Well, that was the idea. Now that exemption from inheritance tax is being limited. You still get the allowance on everything up to £1 million. But if you've got a company worth more than £1 million and you die whilst you still own it, then anything over 1 million is going to start being taxed. Not at the full rate, at least. It's at the half the rate, so that's 20%. But that still means that if you own a company worth, say, £2 million when you die, then the first million is tax-free. The second million is taxed at £200,000. And if you're worth 3 million or 4 million or 5 million, the tax is a lot more. And not many companies have that much money in cash. So this is a really big thing. And we think in the days to come, this is going to be seen in the news and elsewhere as a really key point, which is that this budget has attacked small and medium-sized businesses and is risking a lot of those businesses being broken up on death and not being passed on. It's going to really put a spoke in the wheel of what the Labour Party have hoped would be a budget for growth and a budget for business. This is something which needs to be thought about by any business owner, and if you'd like us to help you think about it, please get in touch. Moving on. My mouse has stopped working, excuse me a moment. Got my technical assistant. There we are. Okay. Thank you, Scott. So buy-to-let and second property is an area that didn't get as much notice in the budget, but there's no changes to capital gains tax. They were the 18% and 24% higher rates, and the other rates have been moved up to meet them. So they've now been sort of harmonised with other capital gains. But there has been a change. Second property stamp duty. There was already an extra amount of stamp duty second property buyers had to pay, buy-to-let landlords and people who just had a second property. They had to pay an additional amount, but that additional amount has been increased again from 3% to 5%. It doesn't sound an awful lot, but if you're in the middle of a transaction, because that's effective from midnight tonight, Scott, is it?
Well, effectively tomorrow.
Well, it's
so
basically,
I presume midnight.
It's basically today. Then if you're in the middle of that, you're suddenly having to pay another, I don't know, £5,000, £10,000 of capital in stamp duty. That's potentially a big deal. And of course, this will affect both sides of the equation. People buying those properties will have to pay more stamp duty, and so they'll be looking for a discount on people from whom they're buying. So that will affect a couple of sets of parties there. So not a big change to buy-to-let holders, but there is that to think about, and it makes buy-to-let properties less attractive, and they're already becoming less and less attractive, frankly, because of lots of extra rules that are being brought in, landlords of regulations that sort of are making extra costs in that area. So pensions in general, we've spoken about pensions and inheritance tax, but just in general, pensions have not been changed as much as we feared they might. So the allowances you're allowed to put in each year, £60,000, which is a lot for most people, or 100% of net relevant earnings, which is basically what you earn. So that's not changed. The reliefs are unchanged. We get relief at our normal tax rate, so 20% or 40%, or if you're a big earner, then at 45%, so that's not changed. The tax-free cash, everybody thought this might be attacked and changed, and some people were so concerned about this, they took out their 1/4 tax-free allowance in advance, just to beat the Chancellor to the punch. But in actual fact, you're still allowed 25% of your pensions, subject to an overall allowance, which hasn't changed. That's £268,750. But at the bottom, you can see that big difference, which I already covered, which is that death benefits, they are going to be subject to inheritance tax. That's relevant for especially people who can't leave it to a spouse tax-free. Other points, I'm going to whiz over these quickly. Non-DOMs, those people who are able to get a special tax deal because they originate from abroad, that's all been abolished. That's all being scrapped. Bags and booze, not much change, really. They're going up as they normally do. Sugar tax on, I think this is the fizzy drinks tax. I think that's the main thing. That's been expanded a little bit. And the VAT on school fees, I think everybody knows that by now. This is private schools, of course, they're going to get more expensive. So who's affected? I've covered this to a certain extent already and sort of picked on sort of areas where you might be affected, but in summary, business owners, individuals and families, especially unmarried couples or single people, and landlords. So just to recap on that, so business owners, this slide is about, well, what can business owners do? And the first thing, I suppose, is the extra cost that's being imposed on them, especially the national insurance costs. Well, Some employers will want to review their costs, especially the employment, and assess how profitable they are. If you can, maybe you can invest in tech to reduce or save costs. And I suppose that a lot of business owners will factor this extra cost in when you're rewarding your employees, awarding bonuses, wage rises, that kind of thing. There are a couple of things you can do. The first one is fairly minor. Salary sacrifice is a way in which you can redirect, or the way in which the pension contributions for your employees is directed. There's a way to do it in which you can shave a little bit off the national insurance increase. So that's something we can help you with. And some people, unfortunately, will consider an earlier exit than they otherwise would have done from their business. I said that the capital gains tax increases were phased over a couple of years. So if you thought, well, damn it, I'll bring it forward to next year, you could potentially save yourself a lot of tax. And if that's something that's in your mind already, that's something to think about now. One thing to say is that despite the changes to inheritance tax, pensions aren't a dead duck. They're not a busted flush. They still do work for people saving for retirement, and they still do work for business owners. They still are a good way to move money from the business. One other thing, director's share protection with the IHT change. This is the principle that if you own a business with partners or co-directors, then if one of you were to pass away, the other people want to know that they can take ownership of your shares in an efficient way and a tax efficient way in order that the business just doesn't flounder with someone else inheriting the shares. Well, the arrangements that go towards making that happen are based on there not being any inheritance tax due. So those need to be reviewed. And again, that's something, if you're a business owner, and if there's more than one business owner, it's not a sole owned business, that's something you really must look at, and we can help you do that. So please let us know. The next thing is family protection. Well, this is just inheritance tax on businesses, especially if you're unmarried. You know, if the business becomes over that £1 million I mentioned, if suddenly there's tax being paid where there wasn't going to be tax before, then that will affect potentially your whole family's financial future. If you were to die, it's no longer just a case of saying, well, the business will pass over or the value of the business will pass over. You need to sort of, okay, reassess and regroup and reconsider on that. And that's the last point. How does it affect your retirement plans? Because an awful lot of people say, well, look, my business is my pension. And if it is, well, that might work very well, but you need to think about how the capital gains tax getting less for your business in the future might affect that. Again, we can help you plan for that retirement. Individuals and families, there aren't as many changes to individuals, but there are some. Capital gains tax, what should you be doing? Well, good practice is always, and we always emphasise this at Rowley Turton, use your annual capital gain tax allowances if you've got share portfolio or anything that isn't in a tax-free ISA. Be canny, be sensible, and make sure you use that allowance each year to stop it building up. When you can, put money to avoid future tax. So put it in an ISA. An ISA is a fabulous invention. Investment bonds is something a bit more complex, but we can help you with that as well. There are ways to put your money to one side and protect yourself from some of these taxes and pay today's lower rates. So if capital gain tax is 10% today and it's going up to 14 and 18%, well, maybe you need to think about, should I be doing things sooner rather than later? Inheritance tax, well, especially if you are in an unmarried partnership, or if you're single or divorced, or you don't have a spouse to whom everything is going to go, look at your inheritance tax position. That really needs to be reviewed. You might decide to make gifts. I think everybody knows that if you give gifts to family members like children and relatives, then there's a 7-year clock until you save the tax. That might be a preferable answer to some of the ways in which people have planned for inheritance tax before, by using those assets which used to be completely exempt, so business relief and agricultural relief, things I mentioned, which are no longer quite as tax favoured as they were, although they do still have advantages. If you do find there's going to be a problem and an inheritance tax bill to pay, you might look at protecting that by having a life insurance plan to pay the tax, so you know it's sorted. And that's something we can help you with. It gives great peace of mind, and it's sometimes fairly inexpensive in order to say, well, I know I'm paying £20 a month, £40 a month into a life insurance plan, but that will provide the money to meet this bill, so I've got it covered. So a couple of other points. Pensions, they still work for you despite the tax relief. Well, because of the tax relief, despite what I've said about the inheritance tax disadvantages now. But this point that we've majored on before about, well, if your pension is tax-free, don't spend it. Spend everything else first, and then you'll be left with a tax-free asset. Well, that's no longer the case. So perhaps you might need to reconsider how you take your earnings. If you're a person that has a pension and other assets, and you take your income in retirement from various sources in a way to maximize your tax exemptions, that might need to be adjusted now. The last point there, I think I covered in the previous slide, which is that higher CGT. If you're a business owner, how does that affect your family's retirement? Let's plan ahead on that, for goodness sakes. Landlords, so, well, I mentioned that before, no capital gains tax changes for you. Stamp duty has gone up. Inheritance tax on pensions, that might have a knock-on effect. You might think, well, I've got my home, I've got a buy-to-let property, I'm okay because my pension's outside of all that. Well, moving that pension in now might mean you have to reconsider the whole inheritance tax thing. So again, I do keep saying this, but we can help people in thinking about this. So please let us know. So conclusion, this is Halloween. It's seasonally themed, but also it's a bit of a Fright Night theme. You know, it's all a bit terrible for some people. To sum up then, action to consider: capital gains tax. If you're a business owner especially, exit early, rebalance portfolios, try and avoid those higher rates. Inheritance tax on businesses, you really need to be looking at wills, protections, how to structure the business so that doesn't affect you as much. Pension contributions still work, but inheritance tax, especially for people who are not married, that inheritance tax position is something you need to think about. A technical point is pensions age 75, there's a change in the way the tax-free cash element works. So in general, we think now that if you're coming up to age 75, and if you haven't taken your tax-free 25% already, you should probably do it at that point. So that's something that we'll be talking to all our clients about who are around that age. Inheritance tax on businesses, well, again, review wills, protection, planning, how the business is structured. And lastly, and I think this applies to all of our clients, whether you think you're affected by this a lot or not, is check your overall position. We have a facility, and we find it very valuable to model future scenarios and look into the future about how you're not only now, but in 5 years' time, in 10 years' time, all through your retirement in your life. And we can sort of put some figures around that and expectations and help you make decisions now. By doing that, sometimes we're able to show people that they're in a good place. It's not all doom and gloom, by no means, but we can help you to do that, help you understand your overall picture, calculate how much you need, and if there is a shortfall, well, we can think about ideas. We'll work in conjunction with your solicitor and accountant and those people who we work with all the time, and we can help you navigate what is a complex financial world, and at least today, anyway, it seems a little bit more complex. So help you enjoy your wealth, that's a tagline. We hope we can do that despite changes. There are always changes, and there always will be. These are big ones, but in a year or two's time, they'll have bedded in, and we'll know what we're doing more, and we'll look back, and hopefully we won't think it's too terrible. Lastly, this is an offer just because you've attended the webinar today. The principles of financial planning, we operate in terms of long-term planning and looking ahead and modelling and thinking about things. It's covered in this book. It's called Enough: How Much Money Do You Need for the Rest of Your Life? If you'd like a copy of that, we'd love to send you a free copy. So please email me, martin@rowleyturton.com or scott@rowleyturton.com, and we'll send you a copy. So I'm out of breath now. Before we do questions and answers, I just wanted to invite Scott to pick up on any bits he thinks I've shortchanged or something he'd like to emphasise. So, Scott, would you like to say something to our attendees today?
Well, thank you, Martin. I think it was some excellent coverage. I think Martin's point about unmarried couples or leaving money to children rather than a spouse or civil partner is absolutely key. I was talking with a client this afternoon regarding this, and there was a couple of issues with this particular client. They're unmarried, two teenage children, and currently there's no IHT issues because the house is owned jointly and there's a £325,000 allowance. And to be fair, most of the money, like a lot of our clients who are kind of growing the wealth, it's in the business, which currently is IHT free because it's exempt, and it's in pension funds because also inheritance tax free. So the client is worth circa £2 million and fundamentally does not have an inheritance tax issue, which is really good. If we fast forward to the new changes, any growth in the business over £1 million is going to be subject to 20% inheritance tax because he's not married, so he'll be leaving it to his partner, but not civil partner. So if that business is suddenly worth 120,000, straight away that's a £40,000 inheritance tax bill, which is the first issue. And then on the pension, which is equally worth best part of £1 million, then today there's no inheritance tax on that, but tomorrow that will be £400,000 when the new rules come in from April 2027. So that is a huge difference to this client. So if he dies today, there's a £2 million estate plus the house of another 300, so 2.3 million, no inheritance tax to pay. If he dies in 3 years, then that inheritance tax bill is going to be at least 400,000. Actually, with a house, yeah, about 400,000, I think. So that's a big change, and that's going to affect his family's financial position hugely. So that's a huge factor. Let's just check the questions 1 second. That's the main conclusion. Hopefully you found it interesting. But we are doing this on the fly more than we would do normally, so I apologise. We'll hopefully get the answers. Okay. Is there any live sound for the speakers? I think we fixed that. That was a problem on our end, so we restarted. So hopefully people have been able to hear us. Otherwise, it's been somewhat of a quiet seminar.
Richard, first question from Richard says 2 years to sell a business before hitting the new high rate CGT. I believe that's to calendar years or I believe that's tax years.
Yeah,
so from April.
Yes, I believe it's. I think it's 10% till April. Then I think it's 14% the next tax year, and then I think we're into 18. So I don't think it's actually even 2 years. Think about that. Is that right? We need to check, but it will be tax years.
Yeah. Tony, hello Tony, an old friend of the company. He says, Martin, how will the net pension fund, after being taxed in your estate at 40%, be accessed by the deceased children? Will they get out the net funds without any further tax, or still have to pay their marginal rate of income tax on any withdrawals? Thanks, Tony. Well, Tony, you have a knack for asking a question which is a real zinger there. Thank you for that. This is something that we've been discussing this afternoon, and we're still not completely sure on. What we think is that the inheritance tax will be payable to begin with. So a £2 million pension fund, for example, will pay £800,000 tax, and then the balance, that amount which falls over the lump sum death benefit allowance, which the amount it currently is just over £1 million, will be taxable, but below that amount it will be not taxable in the children's hands. So that's the answer there, Tony. So inheritance tax is paid, and the balance, some of it is tax-free, but if it's still a large amount, some of it will be taxable at the marginal rate of income tax, so the children's own tax rates.
The other point on that is, and the thing we couldn't get to the bottom of, we were unsure of the interaction of the inheritance tax bill and the lump sum death benefit allowance. So we weren't sure if the lump sum allowance was calculated first and then the inheritance tax came off it, which would be the worst thing because that leaves a smaller pot for you. So you effectively start to pay tax sooner if you've got a decent sized pension pot, or if the inheritance tax was paid first and then the net pot was the bit that was calculated for lump sum death benefit allowance. I'm not sure the government know the answer, to be honest, having looked at the guidance, and they've got a couple of years to work
we should say that some of the changes to the pensions are they've been phrased as subject to consultation period, so nothing is really completely confirmed yet. So we'll let you know. Next question is from Linda. Hi, Linda, you're a client of mine. Thank you for tuning in. So Linda says, what happens if you die before age 75? Does your daughter get the pension free of IHT and still free of tax liabilities? No, I think the situation there, Linda, is that whatever age you die at, the age 75 thing doesn't really matter anymore, for most purposes, that is. So we think that if you have a large pension and you leave to your daughter, it will be added notionally to your other asset, your other estate, to see if you go over the IHT balance. So, for example, if you had, if somebody had a £500,000 house and a £600,000 pension, they'd have £1.1 million, and that will be the amount that will be assessed for inheritance tax. So no, unfortunately, I think that will get you, Lyd. Is that
that's our understanding. Our understanding is that this is a huge change, and that previously we were very keen on you would have £1 million of non-pension assets, because for a married couple with children that was the maximum you could leave out in inheritance tax payable, and then you could have, say, £500,000 in a pension and pay no inheritance tax. As it stands today in our reading of the new rules, if you die after April 2027 with that same situation, £1 million house, savings, investments, etc., and a £500,000 pension, married couple leaving it all to children, our understanding is that that tax bill is now £200,000. So that is a huge change. So we all need to think about that. Does that impact what we do? Do you want to arrange some life cover to cover that tax bill? Do you want to just spend or enjoy it now, or spend or enjoy other monies? There's a lot to say. This is, I think, in the time that I've been doing this job, I think this is the biggest attack on wealthy families, really, that I've seen. It's brought a lot of things into inheritance tax that weren't. I don't think that's been picked up by the press yet. And the issue with unmarried couples in particular is definitely, I think that will go under the radar. But they are huge issues.
Stephen asked a good question. Were changes made to VCT or AIM investments? Yes. On VCTs first, VCTs are a particular kind of scheme, venture capitalist trust with special tax benefits. I had an email from a VCT company earlier today, which I must admit I skimmed, Stephen, so I'm not sure exactly on VCT. My belief is that they've stayed the same. But AIM investments, just for people who don't know, this is the sort of the junior version of the stock exchange for companies that are a bit too small to go on the main FTSE. And owning those shares up to now has given you that business relief exemption I mentioned earlier, whereby if you hold them for 2 years, they're inheritance tax free, which is great. Even though they're risky from an investment point of view, being tax free is great, but no longer. The exemption for AIM shares is still going to have some exemption, Stephen, but only half the exemption. So instead of paying 40%, you will now pay 20% on that. We don't think there's any element of retrospection on that. So we think if you hold those AIM investments now and are on death, they will be considered for 20% tax unless they fall into one of your other already tax allowances.
Yeah, I haven't. We were hoping that if they did this, which they seem to have done, that there may have been a kind of grandfathering to say, well, okay, AIM investments you held, yes, they would be fine, and it only be new investments. We haven't seen anything to say that at all, and therefore, in the absence of that, I think it's fair to assume that no, it will affect all AIM holdings. So essentially, if you've got £1 million in AIM shares and we're happy that they were IHT exempt yesterday, then they will be effectively subject to 20% inheritance tax moving forward. So that's obviously a big change for anyone who's structured their affairs in that way.
The last question at the moment is, how about jewellery or gold? Is it affected by IHT? Well, yes. In actual fact, although people don't often think about it, they think about the house and the pensions and all the investments. Everything you own, even down to the contents of your sock drawer, technically is subject to inheritance tax. So if you have something of value like jewellery, then yes, that is affected. I mean, in the real world, I think often in a family sense, jewellery gets passed away and perhaps doesn't go under the scrutiny of the taxman. But technically speaking, yes, jewellery or gold or anything of value like that you own, it all gets added up along with everything else to pay inheritance tax on. So, I don't think we've got any other questions, Scott. So shall we thank our attendees?
Yeah.
It's a good turnout tonight, so thank you very much. We'll let you all go and have your dinner now. We're going to go and get ours and relax after a long day of scrutinising the budget. Just one final thing to say, which is that at Rowley Turton, we would like to think. Oh no, we've got another question, Gary. Well, we'll cover your Gary close. Does the £1 million allowance on agricultural relief apply to each owner? So if there are 3 owners on a jointly owned farm, do you get the £1 million per estate to use?
I would say almost certainly.
Almost certainly, yes. Otherwise, that
caveated body almost, but yes. So it's per estate. Or per person or per owner, yes. Not for the thing. So when we mention a farm or a business, yes, if it's a £2 million business and there's 2 owners, then that's £1 million each. That's less of an issue. However, of course, if it's husband and wife, so the wife then dies and leaves it to the husband, he's then got 2 million shareholding, which is obviously over the million. So when he dies and leaves it to the kids, he's suddenly going to get an inheritance tax problem that he didn't have today. Yes. So even those don't completely escape it. Also, people still come in with questions.
No more questions coming in. Well,
we got to thank you.
Thank you, Steve.
That's a good point to finish on.
A good point. Yeah, but just before we do finish, just to say that thank you for tuning in tonight. But if you'd like to have more information and sit down, have a cup of coffee and a biscuit at our boardroom table for a no commitment chat to see how we can help you, we'd be thrilled if you'd give us a call. And if you'd like to drop us an email, martin@rowleyturton.com, we'll send you a free copy of the financial planning book. And we hope to see you in the office as clients at a future point. But for the time being, that's us. We're off for a quick drink.
Yes, thank you.
Thank you very much.
Bye.
Bye bye.